Okay, so picking back up with part 2, and I'm skipping ahead here. This is Learning Objective 17.3, but there's a really nice summary paragraph that summarizes a bunch of the slides before it. And I don't want to go through every single detail on each of these slides. And so I'm just going to kind of jump to the summary slide. Feel free to go back and look at each of those slides. And so what are we doing here, right? So this is essentially, we're going to provide some additional information over our standard report, right? And so we've got an unqualified or unmodified, sometimes I call it a clean opinion, but this is essentially, right, there's no, like, we still feel like those opinion paragraphs are true, right? We still feel like the financial statements represent fairly the financial performance and condition of the firm, right? But we just need to provide some additional information. And so how do we go about providing some additional information? So there's kind of a couple of things that we need to do. One is you might provide an emphasis of matter paragraph, okay? And so when are you going to provide this additional paragraph? Well, if there's a going concern, which, remember from the assumptions from either your intermediate or even all the way back to your intro to financial, the assumption is that the firm is going to continue in the future, right? It's going to continue to be a going concern, an ongoing business, right? If there's substantial doubt about that, then managers have to evaluate that doubt and disclose it, and auditors need to evaluate that, both what the managers have done and then also for themselves. Do they feel like there's a concern going forward? And so, there's a lot of red flags there related to, if you have negative operating cash flows, recurring negative operating cash flows, right? If working capital becomes negative or less than 1, if you want to use the ratio, right? That's current assets and current liabilities. If the debt to equity ratio starts getting so large that the interest paid, for example, on the debt is making the firm incur losses, for example. These are all kind of red flags around whether there might be a going concern, right? And so if that's the case, then the auditors have to issue an opinion a paragraph in the opinion that basically says that there's substantial doubt about there being about the firm's ability to remain a going concern, right? And they'll reference like a note in the financial statements that talks about it more fully. And again, the note is the responsibility of managers, right? And so the auditors, though, would reference that. As far as consistency goes, there could be a couple of reasons why GAAP might not be consistently applied. The first one would be a voluntary change in accounting principle, right? And so if there's like a LIFO versus FIFO, right? Oh, it's terrible, sorry. LIFO versus FIFO. That's respectable. Change, then the auditors would have to include a paragraph that basically says, during this year, the managers decided to change accounting principles on inventory, and they would refer the user to the footnote that discusses that change, right? And the auditors have to make sure that they agree with the disclosure, right? Agree with how that note is written Does it adequately describe what the managers are doing? Does it seem reasonable that the managers are making that change? Because if not, then maybe the managers are just trying to get a bump in net income from making a change, and that wouldn't be appropriate. So auditors would basically make sure that that disclosure was appropriate. Then the last kind of category of this emphasis of matter paragraph is that there's a set of issues where auditors kind of have the discretion to add an emphasis of matter paragraph. They don't have to, but they could, right? So let's say there's a major catastrophe. Maybe it's a really large uncertainty that's sitting out there, like some really large lawsuit, for example, right? Class action lawsuit. And it's so large that the auditors feel like they need to put that into the audit opinion again and refer the readers to the appropriate footnote to kind of just to make sure that they don't miss it, right? Or if they have some really large significant party or related party transactions, or any very material subsequent events, right? Like, for example, the firm got acquired between the time of the fiscal year end and the audit report. And so that would be something they would put in the audit opinion as an additional paragraph. Okay, so again, those are the different conditions. What effect does it have on the audit report? It's essentially a paragraph added after the opinion paragraph. There's a possibility we can get to a disclaimer, which we'll talk about in a minute. But ultimately, most of the time, these items go in just in a paragraph in this unmodified opinion or clean opinion, unqualified opinion. Now, if managers do not report and present, if they don't properly present the issue in the financial statements, for example, they had this LIFO-FIFO change, but the disclosure does not talk about why it was done, does not provide information on the effect that it has on the financial statement accounts like net income and cost of goods sold and the ending inventory, then all of a sudden now we're getting to a departure from GAAP, and they're going to have to kind of blank that out. They're going to have to modify the opinion to one of these other categories, which we'll talk about in a minute, that basically just says, now we don't think the financial statements and the notes fairly represent what's going on with the firm. That's pretty rare. It's pretty rare that happens, but it could happen. Okay. Another category is this group audits, and that's probably worth me going back just a little bit in the slides, just to show you. Right, a group audit is when you have one auditor that's doing most of the work, call them the group auditor, but then there's a different auditor that comes in and does part of the audit, right? So in this case, maybe it's an international subsidiary, right? International subsidiary, and so there's an international auditor in that home country that does that audit, for example. But it's still part of the consolidated financial statements, right? And so if that's the case, then let's review what happens in that scenario. Okay, so how to handle these different components, right? In terms of how to audit, what to audit, who audits. So let's say though that subsidiary is not significant materially. Well, then you might be able to get away with just dealing with performing analytical procedures, right? If it's truly not significant and you're not worried about significant risk of material misstatement, and because some firms have a lot of subsidiaries, a lot of them, and so sometimes it's not feasible to be able to go out and audit every single subsidiary. Google, for example, just has an incredible number of subsidiaries. So let's say though that the component is significant materially, like just based on sales, for example, to the group. Well, then someone's going to have to actually audit that component. It could be the group auditors or it could be component auditors. The group engagement team does need to be involved in the risk assessment. They're still kind of driving the audit, and they're going to be talking with the component auditors and the managers. They're going to also talk with the auditors about the susceptibility to material misstatement, right, to make sure that they understand where the areas that the component auditor, again, if they're choosing to use a component auditor, that they need to be looking and collecting evidence from. And then the group auditor is going to review the component auditor's documentation of those risks and kind of how they went about managing detection risk ultimately, right? If the component is significant because there's significant risk of material misstatement, so for example, maybe overall there's not a large financial significance, but maybe there are certain accounts, right, that they worry about could pose, let's see, I'm not going to be able to write that, but certain accounts is what I'm trying to say here. CCCOUNTS, there we go. Certain accounts that are going to be likely to have risk, maybe just because of the nature of the accounts or there's a lot of subjectivity or whatever. Again, they're going to have an audit done. It can be the group or the component auditor that's doing it. And so if the component auditor is doing it, then a lot of similar things need to happen. But clearly, audit procedures need to be focused on where the likely significant risk of material misstatement are. Okay. One point here is group auditors are never forced to rely on the work of component auditors. It could be, for example, the firm made an acquisition this year, and that subsidiary is audited by another audit firm, right? So it could be the case that the auditors, the firm doesn't want to change auditors for that subsidiary, and so they kind of say, okay, you need to work with the main auditors. Well, the group auditor never has to rely on the work. They can personally insist on auditing. If the client doesn't let them, then there becomes a scope limitation and possibly a modification. Most of the time that doesn't happen. Most of the time, unless there's just a really low quality component auditor that the group auditors don't feel good about, then usually they're going to allow that to happen in terms of the component auditor to do some of the work. And kind of the key part will be then if the group auditors take responsibility or not will dictate whether or not the opinion needs to be altered, right? If they take responsibility, then there's no modification, right? So if they feel good enough about the quality and they've had enough interaction with the component auditor and they're willing to take responsibility, then they're going to not have to make any changes to the opinion. But if they're basically saying, you know what, we're only going to feel comfortable about putting our opinion on the piece that we've audited, then they are going to have to add a paragraph in there that says this is what we audited, this is what the component auditor audited, and oftentimes the component auditor is going to have a separate opinion around the piece that they audited, right? And they're going to have that second opinion also be a part of the financial statements. All right, so I'll pick up with the part 3 here for the rest of the chapter.